Are you constantly confused about your financials? See margin swings that don't make sense, see high profitability months and low profitability months, and seemingly no rhyme or reason to it? If that is you, then this video is for you. Today, I want to talk about the concept of cash versus accrual financials and the problems that it will help you solve in your business. We have to start off with, what are the three financial statements? We have the income statement, balance sheet, and statement of cash flows. They all have specific purposes and they all tell specific stories. Too often, business owners focus solely on the income statement and they don't look at these other two statements. The balance sheet answers, are you healthy? The income statement, are you profitable? And the statement of cash flows tells you where cash goes. These statements are all interconnected. The income statement, net income goes into the equity portion of the balance sheet, and then all of the cash movement flows into the statement of cash flows. So often people are looking at their income statement, and their income statement is on a cash basis. But it's never completely that simple. When we look at small businesses, I've broken this into kind of 4 different types of financial statements. The first one is a pure cash financial statement. This is cash in and cash out. This is no accounts receivable, no payable recorded. It's just recording basically what's going on in your bank account each and every month. If you're on a strictly cash financial, looking at that income statement likely tells you the majority of the things that you're going to need to know. The only thing it's really not telling you is what is your cash balance and what debt you potentially have on the business. Pure accrual-based financials tell you revenue earned and expense incurred during that period. We're going to talk about what those things mean, and we're going to walk through some examples here in a minute. We then have modified cash financials or modified accrual financials. Whether you use modified cash or modified accrual, it doesn't really matter because it's really just a modified version of cash or accrual. This looks different in every single business because this is based off of personal decisions that you're making. So maybe you're recording revenue as earned in some cost of goods as incurred, but you're not recording all expenses as incurred. You're recording those on a cash basis. So this is more cash in, cash out with some select decisions about where and when you want to do accruals. And then the last is the tax basis financials. I see so many business owners going to their CPA and saying, we need financials, and they prepare tax focused financials, not decision making focused financials. And then they wonder why they can get nothing good out of those financials. So there's nothing wrong with these. Even if you run purely cash or even if you run purely accrual, there are ways that your CPA is going to modify those books for the tax return. And that is fine. That is to be expected. So let's break down the specifics of accrual versus cash accounting. Again, cash is revenue when the cash is received and when the expense is spent. Accrual is when the revenue is earned, meaning when the job is done, not necessarily when the cash is collected. Expenses on accrual basis are when that expense is incurred. A good example of this is insurance. You'll often pay insurance in one lump sum, or maybe you'll pay it over 9 months or 10 months. In an accrual-based financial, that is incurred every month over that full 12 months. So what we'll actually do is we'll understand the rates and we'll break down that expense over that month. And then on the balance sheet, we'll show a balance that we're likely going to owe that insurance company. There's a lot of other examples with inventory. We'll record the inventory, and then when you sell the thing, it'll then get moved to cost of goods sold. There's a lot of other expenses that go into this, depreciation, assets, whatever else. Anything that is being charged at one time that could be spread over the life of that thing or over the period of use is something that, again, is when it is incurred. So I want to go through an example. So April 30th, we bought 100 units of whatever, and we paid for that at that period in time. 5/20, we sold 11 of those units that they weren't yet paid for. And then on 6/11, those 11 units were paid for. So what does this look like when we look at cash versus accrual? So I've broken this into kind of a little flow chart here. And we're going to start with that first piece. In cash, when that $1,000 is paid for that 100 units, that expense goes directly into the income statement on that day. In accrual, you record the inventory on 4/30, but on the income statement, that expense doesn't happen until those first units are sold. And you're only expensing the number of units in relation to what was sold. So you'll notice 5/20, you had 11 units sold at $220. And then you had 5/20, 11 units expense occurred. This is actually not 220. This should be $10 per unit. So this should be $110. Screwed up there on this. Apologize for that. So that is how accrual goes. Then on the cash, not until the payment is received on 6/11 is that truly recorded. So what you'll notice is on the accrual, the revenue and expense line up. You can see a really good gross margin for that product, even though I screwed up the 220. On cash, you show revenue in June, but we show no expense in June because that full expense was taken in April. You also add in the inventory to this. And in accrual, you're going to show 89 units in inventory. In cash, a true cash, you're going to show 0 inventory. You're never going to show inventory. It's all expensed immediately. This is where some people do a modified version and you'll see them recording inventory, even though they're not doing true by the book accrual. So when you look at this from an accounting period, this is what I walked through here. Of period 1 in a cash basis, you're throwing an $1,000 net profit loss. Then in June, you're showing a $220 profit. So at the end of those 3 periods, you're still showing a loss for the business. Though in reality, you sold it for 220, it cost 110, so you're showing a profit of 110 in accrual. That is actually more close to a true profit. Now, if you didn't sell all those units, you had to write those units off. There are rules in accrual that account for that, but again, that is the general rule. So, what are the principles behind accrual accounting? That principle is one, revenue recognition is recognized when the revenue is earned, not when the cash is received. So, when that sale happened, even though cash hadn't been collected, not when it showed up, but when someone committed to buying it is when the revenue is recognized. The other one is the matching principle, that revenue and all related expenses are recognized in the same accounting period. So if there's revenue, cost of goods that's directly related to an expense, that happens in that month. And then we've also talked about when that expense is incurred. So it's spreading the expense over the life of whatever is happening. When you start doing accrual financials, this is where the statement of cash flows comes in and where it can be really, really important. And so we can learn a lot from the statement of cash flows because when the income statement quits showing cash in and cash out, we need the statement of cash flows to better understand this. I'm going to go through another example. So we talk Itchy Inc., a tree spraying company, provides a monthly inspection prevention spraying service for its customers. A customer signs an annual contract, pays $1,200 upfront on June 1st, 2020. Itchy pays the chemical supplier $50 for each tank of insecticide when it picks up the tank the morning of each monthly spray. So this is a real easy scenario because there's very few variables. $1,200 in revenue in June and $50 in expenses each month, June through May. So if we look at this particular flow, with cash basis, we record that revenue, $1,200, and that expense each month when that new tank is picked up. So what ends up happening, December of 20, we show taxable income of $850. but then through May of 21, we're showing a loss of 250 because there's no revenue that aligns with that income or with that expense. On accrual basis, how would this look different? Again, we've changed no variables here, but accrual requires that we evenly prorate that $1,200 to all the months that it aligns with. So what ends up happening is we prorate that over the 12 months and we show $100 of revenue each month to $50 of expenses. So what that means from a taxable income is we show $350 in taxable income December 2020 in this first scenario or the first year, and then 250 in the next year. If we compare these side by side, you can see it's a stark example. By recording this revenue on cash basis, this business is paying taxes early and then showing losses later. You'll notice that 350 plus 250, 850 minus 250, those are the same numbers. There's no change in the actual profit or loss, but the way it's getting recorded is significantly different. So the pros and cons of each type. The pros of cash is it's easier to implement and maintain. You're explicitly looking at cash flow. It's the simplicity of that is great and helpful for new business owners. It can be great in simple businesses where we don't want to overcomplicate things. And then you only pay taxes on the cash received. The hard part is it's really hard to understand your true profit unless you take really wide swaths. You can't tell on a month-to-month basis really well because if you have big swings, depending on the type of business, there can be a lot of noise in those numbers. And it's too simple for complex businesses that require a detailed balance sheet. So when you get debt involved, when you get bankers involved, this cash financial often isn't going to be the right answer. On accrual, the pros is that you're going to have a better understanding of profit. Being able to accrue things across periods is going to give you a more level profit number and give you a better idea of what your true profit is. And then financial positions can be really easily tracked on the balance sheet, understanding your obligations and understanding a truer health of the business. The cons, harder to implement and maintain. People can make mistakes. If you get a bunch of big adjustments all the time, there can be swings, just like in the cash. And so you got to have a good, experienced team helping you with that. And then the con is also cash flow having to be tracked separately. I think that's actually a benefit because it forces us to look at cash flow and it forces us to think about that connection between the income statement, balance sheet, and the cash flow. But some people, again, that can be a negative as well. So what is best for you? I prefer cash businesses. So IRS, and this number may have changed. I forgot to check before, but if you have over $26 million in revenue over a 3-year period, you're going to be required to do accrual financials. So you can't do cash anymore at that point. If you're a qualified professional service corporation, so this is health, law, engineering, architecture, accounting, a lot of these examples, any type of consulting, often cash is what you have to do. Where we prefer accrual is when we have inventory records, subscription services, we have credit that we're extending. So meaning, there's deposits or things that are, needing to sit on the balance sheet, and we have to understand what those obligations are and what is money that's not yet free to be spent. We need to understand that. And then if you're growing rapidly, often that means swings in margins and what that looks like. And so we want to focus and get to accrual to better understand our margins so we can grow in the right ways. So when should you switch? You should switch to accrual, margin swinging wildly because the timing of cash, you have inventory, you invoice before you get paid. And so that is maybe a little bit of a loose rule, but if you have a bunch of outstanding receivables, we're at least going to be on that modified version. If you receive deposits, we need to record that those deposits are there and track those deposits. That's a good point to have accrual. If you have meaningful prepaid expenses, and so that can be a good trigger. If you're trying to manage your team or reward your team based off of financial incentives, yes, accrual can be more confusing, but you're going to get a more accurate number that swings less. So you're going to have more fairness or feel like there's more fairness in the process for your people. If you have a lot of capital planning, where that profitability insight is helpful. If you're thinking about selling, acquiring, or raising capital, being able to have a really clean set of books is helpful with that, and accrual is going to be helpful in having a deeper understanding of what actually is going on. And then if you're not understanding that, yeah, we're profitable, but I don't have cash and we're having that problem over and over again, we want to understand true profitability so we can understand where the profits created, where that cash that should be coming in, where is it going? Is it getting distributed? Is it getting reinvested? Where's the cash disappearing to? Is it not getting collected? There's often many different ways that we can approach that. When we look at accrual expenses, there's really 5 types of accrual expenses. We have accounts payable and receivable, prepaid expenses, accrued expenses, unearned revenue, depreciation, and amortization. So as you go through, understand what's common in your business and what makes sense for you. Again, going back to what we talked about of kind of the types of financial statements, tax basis financials are always going to be there. We don't need to worry about what the CPA or person preparing your taxes is doing. Most people are going to be on some sort of modified cash or modified accrual. I'd encourage you at minimum to get there, be on cash set, but choose to be accrual and matching revenue and COGS, and maybe a few other big swinging things. Like if you have bonuses each year, be accrual on those bonuses, record your depreciation so that you can see a closer true profitability. This seems like a hard lift. It can be a hard lift if you don't have experience in accounting, but find the right partner. And I assure you, you're going to have a better sense and control of your profits and overall business. Thanks for watching. Talk to you again soon.